Okay, go ahead.
We spoke about how the large government there was split into smaller governments for each sector of the American that was split up that time.
Okay. Where does the power reside in large part, Jonah? Or you can say whatever you wanted to say.
I'm going to say something similar to like there's more power locally.
Okay, good.
And,
there's more power locally than nationally, and so we actually still have that kind of on the books, but the idea with the founding of the United States was to say, let's keep the federal government limited. So limited powers of the federal government. Don't tell Philadelphia what to do, Baltimore, and whatever, right? So you guys live your own lives. We all have individual economic freedom. You pursue your own interests, life, liberty, pursuit of happiness, right? And so let's have a federal government. And what JC was referencing with the Federalist Papers that we did in entrepreneurial economics was just that they were whether we should be the United States or America. It was basically the 13 states. Should we let all the states kind of run rampant, or does it make sense to kind of pool us together? And their ultimate solution that passed in the way we have it today is that let's keep the federal part really limited, and then you got the states with more power. And then each state has local powers. And so you've got the federal law. Let's pick on racism or slavery rather. So slavery is allowed at the federal level in the beginning. Everybody agreed it was kind of wrong, but then we have some states that were slave states. Kansas was a non-slave state, Missouri was, right? So we were one of the only, did you guys know that that's one of the vertical battlegrounds? If you draw the blue states and red states as far as with the Civil War. And that's what, so Lawrence is known for one of the starting places of the Civil War, the burning of Lawrence. And there's really a big history that I've come to learn that I never really knew about until I moved here. So then you've got, slave states. So what I'm saying is that states were able to say, you can have slaves, you can't have slaves, right? And then, the municipalities had to follow whatever the rule was of that state. So then we say, you know what, slavery really sucks, and let's make that the law of the land. So now that law moved up to the federal level, so states do no longer have that authority. So the idea is, let's keep the federal ones are the ones like getting rid of slavery, duh, right? Like, let's get the stupid ones, everybody's got to follow those. But it's a relatively small set of rules, right? When it comes to, what you can do for others. And so you got, the protected classes and all of that, the federal laws that have changed over time. Some really good ones on the books that let's just as Americans agree that that's what they should be. But let's keep that pretty small and then keep the states in power with stuff like taxing. So when the nation started, and even prior to the Federal Reserve Act, and it came into be the Internal Revenue Service. You guys know that thing that's coming up April 15th? What does the IRS do?
Make sure you're doing your taxes.
Tax. What do they specifically collect? What type of tax? Income tax. So it's federal income tax, right? So it's income tax. Well, that didn't even get started until 1913. So it just coincidentally was about the time of the Fred. And so the states had a lot more taxing power. You want to live in my state? Here's the tax rate. Here's how we do it in our state. And the federal government had a very little taxing power. They didn't do a lot of spending either. There wasn't a huge amount. It was like 3% of GDP or something in some points in history. 3%. Like, just maybe we do national defense or whatever. We keep it fairly small, states here, and then you can live in my city or county with the county and if I want to do a full-blown thing here, it'd be the city too. So then we go down to the city level. So in other words, you can keep adding laws on as you move down. So the most laws that you live under reside down at the city level. Because the city might have additional laws besides the county, and the county has additional laws besides the state, and the states might have additional laws beyond the federal government. So federalism is the idea of setting up the country this way, where the power is with the people at a very local level. And then that allows us to vote with our feet. So you might like cities that have a lot of spending on theme parks and walking parks and other things, and the tax rates are this, and this is how they pay it. And that might suit you. Everybody's different, right? And other people might want to say, I don't want to do that kind of thing. I'm going to live in this city. And so then you just move from city to city or state to state, and the government doesn't have much control. The beauty of this system, and I've been talking way too long on this, I hope you guys are getting something out of this. Meant to be just a little teaser, and this is not all-inclusive, of course, is that if the federal government stays limited, and the powers of the presidency stay limited, and the powers of the Congress stay limited, we don't really care who's in the president. We don't care if it's Trump or Biden or Hillary or George Bush, Ronald Reagan. Pretty insignificant, right? It's more important probably who your governor is. And you have a little more voice to go run to Topeka, Kansas, our capital, and say, hey, I don't like the way things are in our state, right? Now, that's a little harder to do, to run to Washington, D.C. and talk to the president, right? So you see the beauty of the system, that it kind of has a way of working that could be nice. How did we get to where we're at? Where did power start to get sucked up to? All the way up to the top, right? So it's like just little by little, year after year, we just kind of have a new policy. Oh, wouldn't it be great if we had this? Or possibly the Great Depression is probably the classic example of, we need to have a bigger role so that catastrophes from the market system like this, don't hurt people. That sounds great. If it was possible, if that really led to better outcomes. I think the question mark is, did it lead to all better outcomes? I think in some cases there's definitely trade-offs. And so can we start where we're at today and continue moving this direction and have a best place to live? That's the real challenge. So I kind of brought you through the course of American history there. And can we turn the needle to making this smaller and pushing more power down to the states? I don't know. It might be a lost cause at this point. But part of that now, I finally get to my book club pitch, is that the book club theme is going to be on federalism. So I think we called it freedom, and then maybe it was federalism. Federalism, freedom, and flourishing. And so we're going to have readings about that. The other reason I wanted to spend so much time talking about this is because I'm really going to be looking to some of you, upper division, econ, you don't have to be an econ major, but people who are interested in this, to be the first members of our PPE League. So instead of doing the colloquium, how many of you have participated in the colloquium where we have that reading day where we go to the smoke creations or whatever, or different types of events? Okay, so we're not doing that this year. We're going to go to Emporia State University and compete with them in a competition. And you're still going to get paid $100 to do it. And part of the reading, or part of what we're going to be doing, is based on this book club reading. But you don't have to be in the book club to be in PPE League either. But it'll be kind of a double dip for you, that will be going through the readings, and it'll be part of the PPE League. So that's part of our spring action with the Gordy Institute. And that's why I wanted to spend a little more time here. You're really going to be competing against Emporia State in a number of games, let's call them, or activities that are, you need to be knowledgeable about what federalism is. So, questions or comments? I threw a lot. Yeah. The book club is, and we're going to be advertising it here shortly, especially at movie night, but we'll be sending out stuff. The 24th, is it? 24th? It's 3 weeks. No, don't check, David. It's not that big a deal. It starts I think it's the 24th. It goes 3 weeks before spring break. And then the PPE League competition with Emporia State is just a one afternoon event, I think is what we have planned. We're kind of flying by the seat of our pants with this. You guys are kind of the guinea pigs. The Gordy Institute has vision of making this a national thing that lots of universities compete in. So this is the trial run of this to see how it works and kind of work out some bugs and kinks and stuff. I think that is Tuesday, April 7th or something. It's going to be PPE. So we're kind of building this up as we move through the semester. Okay. Any other questions or comments? What's that? Pre-apply. Yeah, we'll have the application stuff coming out here shortly. So, and sure, we'd like to get a group of about, for the PPE league, maybe as high as 16 or so, kind of similar to the colloquium. And everybody who participates will get $100 for that thing. And then we got the book club too that'll be kind of set up similar with learning federalism. Okay, so that was a fun talk about hedge funds. How much time do I got left in this class? Okay. So we're right on the verge of talking hedge funds, which Allison will also talk about. All right, so hedge funds. Speaking of hedge funds, what is GameStop at? Does anybody happen to look? 60? Oh, it's the march downward. Okay. Interesting. All right, so $60. So hedge funds, usually a minimum investment, typically $1 million. Minimum of 1 million investment by each partner. So this is going to be a group of people. Less than or equal to 99 investors. There's going to be kind of a minimum net worth. Minimum net worth requirement. What's net worth again? Okay, own what you owe. So assets minus liabilities. If we got our accounting hat on, so your net worth is probably going to be needing to be probably at least 5 million. So we've got the dollar value of what we own. This is your personal net worth of assets and the dollar value of what you owe. So each hedge fund would have their own minimum requirements. There's nothing set by law. And so there's very little regulation. So they're not filing always with the SEC and other things for their particular company. It's just a bunch of fat cats that are getting together to do some shorting of GameStop or something, right? We actually our podcast yesterday that'll come out Monday was on, we talked about GameStop and kind of had some fun with that and brought up a lot of different issues. So you guys might want to tune into that. Do you guys even listen to podcasts now? How many people listen to podcasts? Oh, really? Gosh, more than I thought. Okay. Well, do the Faith and Economics podcast by the Gordon Institute. We have a good time with that. Okay, so let's look at the setup here. Hedge fund structure. So, example structure. So let's have Russ Capital Fund. LP. Russ Capital Fund LP. So Russ Capital Fund Limited Partnership is what the LP is, which is a IRS federally not regulated, but recognized form of entity, right? So you can have, you can run a business and be a sole proprietorship. You can be a corporation. You can be a partnership. You can be a limited partnership. So you can study those in other classes, different ways that you can structure your company. All right, so we bring in some people, and we end up having $100 million. And this is in January 1st, maybe 2020. And so we've got any number of partners up to 99, but let's just say we've got a couple people with a 30% chunk, and a 10% chunk, and a 20% chunk. Is that adding up? Yeah, that's right. Okay, 30, 30, 20. And then the last chunk here is 10%. So we got 5 partners that contributed various amounts according to their equity percentage. So the 30% guy put in $30 million, right? 10% was put in and owned by me. I just put in 10 million. I'm kind of a poor guy. So, but I'm the smart guy with a PhD in economics that knows the financial system, and I'm going to be running this hedge fund by using Russ Capital Management.
To be a hedge fund manager, you have to contribute. You have to find the minimum amount.
Typically, you have some amount because your other partners want you to have skin in the game.
Right. So you're not just investing in other people.
Yeah. So I'm not just an agent. So the hedge fund owner, or the hedge fund, I should say the hedge fund manager, would want to have, or these guys would want this guy to have some skin in the game, so to speak, and a significant amount of skin, right?
Oh, if they
And why is that? Why would we want Russ to have some skin in the game? Jonah? Carefully, and so what specific problem do we call that? We've got those different problems, Eddie. Moral hazard, yeah. And there's actually even a narrower definition of what that one is called under the moral hazard umbrella. Principal agent problem. So by having some skin in the game, hopefully we'll keep Russ honest. So Russ is the general partner. Russ is the general partner, and these guys, let me start using other colors here. These guys are the limited partners. Now, what have you guys learned in other classes? What's so limited about the limited partners versus the general partner, Eddie?
The liability.
The liability. Which one's limited?
Limited partners have a lot less, not obligation, but liability.
What's yeah, they have less liability. In fact, what are they limited to losing?
Their state.
The money that they put in. Yeah, so the most they can lose is 30 million. The most they can lose is 10 million. So that's part of their limit of liability. Russ, on the other hand, can lose it all and be sued for more if something goes wrong with this. So these guys are just like, hey, we're going to kind of trust Russ. Of course, we're going to keep an eye on him. I'm glad he's got 10 million in this deal too, and I trust him. But of course, I'm rich enough to have attorneys and other people consult to make sure that what Russ is doing is legit or whatever. So they're going to be keeping tabs on each other. But that's the idea, so that if something happens that causes a loss of the company that's greater than the amount of assets, I'd still be on the hook for it. Okay, so any other questions on the setup so far? By the way, I set up a lot of my real estate deals this way. This is very similar to how you can set up real estate interests. So if you don't use either LLC, and notice I have an LLC here too, so that can help limit my liability in this ownership. So you can kind of have these layers of liability protection, but that's the structure. Okay, so now how does Russ get paid? Well, because I'm doing such a good job, I get a 2% management fee. So I get 2% management fee on the size of the fund. So let's say that, in fact, let's see, let's go ahead and draw the next January 2021. You guys can put it right below. I'm just kind of squeezed for space, depending on how you want to set this up. But let's say Russ does a pretty good job and grows the fund at the end of the year to 120 million. So after 1 year of doing investing, we had a great year, had a 20% rate of return on our investments basically. And so now the value of our investments is up to 120 million. The ownership structure, of course, is still the same. The 30, 10, 20, 10. So all that's just the same. But now it's worth 120 million. So my management fee that I'm going to put in green, we're going to use the average of the two. So over the course of the year, I was managing on average 110 million. And of course, the partners would have this agreed upon ahead of time, how we're going to value what my management fee should be. So if we just take the 120 plus the 100 divided by 2, gives me average value of my assets over the course of the year of 110 million. So this is the average asset value, 110. And then Russ is going to get 2% of that, which is $2.2 million. Because Russ needs to buy a little vacation home that he's had a hot eye on down in the Caribbean. So this is literally my income. This is the management fee.
Hey, Russ.
Yeah.
Can you tell me where you get that 110?
It was averaging the value of the portfolio from 2020 was 100.
Okay.
2020, at the end of the year, it was 120. And so my agreement with my partners is we take the ending date and the starting date, average the two, and that would be my management fee.
Okay.
And again, you could have something else different, but places can do it this way, kind of an easy way to calculate it without getting too messy. All right, so that is, income to Russ. So Russ needs to run his company. That's my general income. This guy owns Whole Foods, right? This guy owns Facebook, and this is Jeff Bezos, right? They don't want to run their investments. Russ's full-time job is running the hedge fund. And so my income is 2.2 million. Look at that. Well, it's a little cheaper than I like to go, but not too bad. All right, everybody got any questions there? So when I said yesterday during the presentation at the end, I told the students, I said, if you're a finance major or a economics major, or you're interested in investing and stuff, because the moral of the story was, don't waste your time if you're investing, learning about stocks and spending hours if you don't really like it. If you've got better things to do with your life, go work your job, make babies, live your life, and invest in mutual funds. Because then there's a Wall Street person who does all the hours. That's this person, that's Russ Capital Management. They're the ones spending all the time. Hopefully they find the right investments, or you're diversified enough in mutual funds. You don't have to do that. That it's a waste of time. So, but I didn't want to discourage freshmen and sophomores from becoming finance majors. They're like, oh, I didn't know it's a waste of money. And I'm like, wait, if you really get off on doing that, if that's where your passion is, you need to come join Russ Capital Management. They will pay you an income to learn about stocks and be on top of the ins and outs of Wall Street and all that jazz. So there's professions out there that you can earn an income, but you're still not going to be a stock picker that makes most of their money by beating the market, because no one exists that do that. I brought up Warren Buffett, that even Warren Buffett doesn't systematically beat the market. So you're better off keeping your long-term investments in the market rather than by using S&P index funds or ETFs and mutual funds, stuff that we talked about.
How's that go?
Great, yeah, really good reviews back from the students, so it did go good. One comment was even, the Gortney Institute is the GOAT. And I just gotta be honest, it's probably a function of my age. I'm like, I think that's something good, but I don't know what it is. So I Googled it. And so then I learned, wow, that was actually a pretty impressive comment, even though I'm sure you guys say GOAT all the time, like not really meaning the greatest of all time, but I'm like, no, that was catching. All right, so anyway, so here we go with our 120. So now once we skim the management fee off the top, the fund value is going to fall, right? So now we got to subtract that 120. So first of all, if we subtract off the 2% management fee, 120 minus 2.2 million gives me 117.8 million. So we got 117.8 million left in the fund. And now Russ gets his other bonus. This is just my normal income. Of course, they want to give me some incentives. So I was going to get 20% of the profit. So now Russ gets his other kicker. So 20% profit incentive / commission. Now this is where Russ gets to buy the Rolls Royce. So 20% of how much did we make? After taking management fee, that's just my normal income. 17.8 million. So now we got 17.8 million times 20% gives me 3.56 million. And now that goes back to Russ Capital Management LLC. And now you start to see the Wall Street executives really looking good. Now this would be fun. I hope, I don't know if JC's putting a little word in with our local OU alum hedge fund guy, Wiley Angel. So hopefully that, I don't know if you've heard back from him at all yet, JC, but he manages this. This is the type of stuff he does. He's one of these Russ Capital Management type guys.
Is that the guy that came and spoke to us in intermediate?
Last year, yeah. Yep, a little over, yeah, I mean, was it intermediate? I can't even remember.
I think it was intermediate.
Yeah. So he's based out of St. Louis. So you don't have to be on Wall Street to do this, by the way. With today's, we got computers and trading and all sorts of stuff. So this type of setups going on all over. I mean, there's thousands of these types of setups going on, managing different types of things and private portfolios. All right, so, and actually, I don't think, if I remember right, Wiley, and JC, you might know this, Wiley actually doesn't manage a hedge fund, I don't think. Yeah, he's got his own mutual fund company, so it's a little bit different, but similar concept.
It's 17.8 or
It's 117.8 at the end of the day when you subtract, I'm sorry, now we're gonna do one more calculation here. 117.8 was after you subtracted out the management fee. And then now I'm gonna get paid my profit cut of the 3.56. So we're gonna now minus 3.56 million. And we're left with the final value of the fund, the new starting value of the fund, 114.24 million. 17.8 was from the 2% management fee taken off of the top of the gross value of the fund. So this is the gross value of the fund. Over the year, the fund grew from a $100 million value to 120. Russ gets his money of the tune of 5.5 million, and the fund is left over with 114. So what was the percent rate of return after fees for my limited partners? 14%. They didn't get any cut of that, right? So I had this money coming out separately. So my partners, my limited partners got 14%. S&P 500 did 12%, so I beat by 2, right? Pretty good this year. Kayla.
What he's saying is in the box up there, it says 117.8 million, but when you go down below in your calculation, it's 17.8. Is it
Okay.
because you only have 10%?
Because we started out with.
We started out with 100. So this is a profit incentive. And so the profit, if I back up one step here, is we started with 100. We ended with 117.8 minus the 100 equals the 17.8. So we're here before the profit cut, right? So now we're trying to figure out McCullough's profit cut was based off of the 117. I got a 20% share, and my partners got an 80% share. So the leftover, by the way, the 14.2 is approximately 80% of that profit, right? The partners got, I should say everybody got, because I'm one of these two, everybody got 80%. McCullough got the special kicker of 3.56 million. That Rolls Royce was calling, not 8.
Then 8% is about 30%, 30%.
Then it's back to these partners, yes. Okay, any other questions, clarifications so far? I still got more to go here too, Rex.
Do they have, so when they come from that 114?
Yeah.
Will they just use that to go into the next year?
Yes,
Or will
well, they already own, this is like existing ownership of stocks and whatever they're investing in. The short sale from GameStop, if they were still in a position at the turn of the year, then that would be included in this. So this is the overall net worth of the hedge fund, the value of the hedge fund.
So do the partners, do they get cuts of that 100?
Okay, that's what I'm gonna do next,
Okay.
is where that comes from. Is that what your question was too, Summers? Okay, so now, if I'm a partner and I want some money, I don't wanna let it ride, how do I get my cut, right? So at the end of the term, and this is agreed upon in your operating agreement with your partners, is that at specified periods, partners can withdraw. They can withdraw 100%, or they can withdraw a fraction. So this is called an open-end fund. An open-end fund. So if the hedge fund is an open-end fund, which many are, a closed-end fund keeps the shares the same. Then you can sell your shares if you want. But so if it is, then at specified periods, the owner, or an owner, maybe I should say, an owner can redeem shares. Basically cash out. Part or all of their position. So example, let's say the 30% partner cashes out 10%. So he doesn't want to cash out everything, he's just going to cash out 10%. So how would we calculate what he's entitled to?
117 times 38 times 10.
117?
I mean the 114.
114, yeah. So that money's gone as part of the income to Russ Capital Management. So the ending amount here is the 114 is what we're dealing with. And so 10% of 114, I got kind of some easy numbers here. So 10% of the 114 point, what is it, 24 million equals 11.424 million. So the big partner wants to suck out $11 million worth of cash. And let's just say that all the other partners want to leave their money ride, right? They're going to let it ride. So if they do that, what is the new hedge fund value? 114 minus the 11, right? So the new hedge fund value reduces to 114.24 minus the 11. 424. All right, 424, yeah. 102.8. 102.814. So now our new starting value, because we're going to do this at specified times, and let's just say we do it once a year when we figure out what Russ's management fee. Okay, anybody want to cash out or not? And we run through this exercise. One person leaves, and now we've got this. So now what happens to the ownership values?
The 30% one gets smaller,
Okay, the 30% one gets smaller.
but they also all have more money.
They all have more money. So what's going to happen to the other guys? So definitely the 30% partner has got to go down in value, right? He doesn't own 30% anymore. He just got rid of it. What happens to the other owners' percents? They go up. Yeah. So their dollar value still stayed the same. So if we look at the 114, somebody like, let's say Russ, still owed 10% of it. So 10% of 114 is still the 11.4. But now I have 11.4 of 102. So that would be my new percentage ownership. So I'm going to get rid of this one. You guys have this already. So I'll just put in general, other owner values would adjust pro rata according to the dollar value divided by the dollar value of the fund. So for example, the former 10% partner now has, the former 10% partner still had 11.24 million divided by the new denominator is the 102.814 million. And I don't have this worked out ahead of time, so go to the calculator.
Hey, Russ.
11 point what?
11.
11.11.
Hey, Russ. Can you bring the phone closer to the board? There's like a reflection with the lights in that green. I can't read all that.
Yeah, I see the reflection a little bit. Did that help?
No. I mean, a little bit, and then like this at the bottom, but like that owner
We're
value.
almost done. Let me get you at the end of class, Luke. We're almost done.
All right, sounds good.
So any questions on this? See how that worked though? So now we own more and the other guy owns less. The whatever their fraction reduced down to, that would be how it would be reset. We go another year, Russ either makes money or loses money. By the way, if Russ loses money, it could be that there's no profit incentive, or maybe it could go the opposite direction, right? That I actually have to pay in, or I lose part of my ownership share, that depends on the structure of the agreement.
So there's still a management fee if there's loss?
Yes, there'd still be a management fee. So typically, the management fee is gonna stand win or lose. That's kind of the baseline income, and then there could be adjustments above that.
It's just like an overhead cost, right?
Yeah, yep, basically like an overhead cost. All right, we'll call it a day there.